Hello and welcome. My name is Oscar from the Finance Society at Stockholm Business School. Today we're going to talk about moving averages, and we're going to talk about the simple moving average and the exponential moving average. What is a moving average, you might say? There's a or a moving average of X. So let's say a 200 moving average, a 20 moving average, a 50 moving average. Let's say a 50 moving average. That's the last 50 data points, the last 50 bars in this chart, and just an average of that. So where the average is now is just the last 50 points. In this case, it's a close. You can usually depends on what software you use, but just you can choose in the settings if you want to have it on the close, open, high, low, and weighted in different ways. I usually just use closed because it's the most important data. So today we're going to look at different ways of using the moving average and what is a moving average. And the simple moving average is just simply the close, in my case, of the last 50, or in this case, the last 20 candles. The exponential moving average is using a smoothing factor that places a higher weight on recent data. So this red one is more puts more weight on the recent data. So in this, it's the last 20, but let's say the last 5 is more weighted than the first 5. So in this case, we're going to have a higher curve than the simple moving average. Myself, I only use the simple moving average because I don't see any reason to just mess about with the exponential, but I know some people use it. The exponential might be good to find some trends, like when the exponential is greater than the simple. That might be a trend. You can use it in whatever way you want to do it. Best way is trial and error. There's different ways of actually using these averages. We're gonna look at crossovers first. Don't really like crossovers, but that's another video. Some say that when 20 is greater than the 50, you should buy the stock. So here, you should have bought the stock. This is actually a 15 moving average I see now. But that's the thing. People want to use 15. Some people want to use 7. That's just trial and error and whatever fits you. I don't like the crossovers because there's so many fake outs. But let's say you buy at this crossover. That means you buy here at 224, and then you wait till it crosses over again. It hasn't done that, so you would still be in this trade at 420. This is a weekly chart, but if you just look at a daily chart, you would here go long at, let's say, 334. Then you wait till it goes under. That means you're out at 323. That's a loss. Then you go short again at 323, and here you go over. You get out at 319. You're over, so you need to buy, and then you under. So it's just zigzag all the way. This is what I mean with all the fake outs. You should use, if you want to use the crossovers, you should use a crossover plus another indicator, like say you have a good trend line in this area, or you have an oscillator. We will come to that later. Something that tells you that this crossover is not a fake out like these. But that's up to you how you want to determine if it's a good crossover or not. And now we're going to look at how I use them. These are just 20, the blue one, 50, the red one, and 200, the green one. As I said in the previous video, these are, especially the 200, is a very good support area. Get to the 200 bounces. Get to the 200 bounces, get to the 200 bounces, etc., etc. So you can use it as support and resistance, of course. You can use the 20 and the 50 as well. I would say the larger the the moving average, like say the 200 is bigger or larger than the 50, I would say the 200 is more important than the 50. Same way as the 50 is more important than the 20, etc., etc. But the 20 moving average, I think, is pretty interesting. I don't remember who said it, but he had an analogy that the 20 moving average is the shoreline of the beach, and the candles are the water. No matter how long the water can never be away from the shoreline forever. If this, well, theoretically, this stock could just go up and up and up and up and up infinitely, but that's not going to happen. So when the price get extended enough from the 20, you know that either the price is going to slow down and the 20 will catch up, or the price will go down while the moving average keep climbing because of the higher numbers in the calculation. So it's always going to hit the 20 again. That's good to think about if in the long run when the stock is just going. Just think of it as water on a shoreline. It helps me at least, and that's something. Again, I just use these as support and resistance. Not maybe the easiest to spot. This is a pretty bad chart for that, because so would be more than the 200 though. You can also see the 20 or 50 as helping it to blast off. Here we have somewhat of a flag. We will go over flags later. And you see we go up, we consolidate sideways. The 20 catches up, and the 20 just pushes the stock up. We don't go through the 20. The 20 helps us to reach higher. So I usually use the moving averages as a help to when we're gonna move and when we're not gonna move. So in this setup, I would rather buy it here when we're close to the 20 than around here when we're not close to the 20, because I know the 20 will help us to go up. Again, I would not trade off only the 200. I would use the 200 plus a trend line. I would use an oscillator. So we've gotten so far now, so you know how to read the chart. What is a chart? What is a trend? So all these bits and pieces that I'm presenting for you, I want you to pick and choose the ones that you understand, and you just read up on some different websites. Investopedia is a good place, etc., and just try and learn some indicators and then just put them together. Let's say you like moving averages and you like trend lines. Then you just try and match up where you can find a trend line and a moving average at the same place. Let's just do this, and you see you connect this to this and this. Oh, maybe this would be a good area for you to trade. This would be a good area for you to trade. This, you got two moving averages and a trend line. So you just have to make your own. I will not give you my secret recipe, if you want to call it like that. I want you to experiment yourself, and by trial and error, just find your own way of trading. Because of course I will tell you what I think is good and what I don't like, but I will not give you this is my strategy, use it and succeed or fail. But I want you to try and understand and apply it yourself. So what you want to do is you want to stack the odds in your favor. The trend line is something that will help the stock go up. The support from the 200 is going to help the stock go up. This oscillator you're using is going to help the stock go up. So you just want to stack all these elements in your favor. and hopefully you have enough indicators that you find this trade in time. And the more indicators you have, the stronger this trade is, and you should take it. Always with a good stop off, of course. And we're gonna come to money management, I think next week or the week after that. So yeah, that was my short rant on moving averages. I hope you got anything out of it, and I hope you have a good week, and talk to you next week. Bye.